Welcome back, everybody, for another deep dive. Today we're looking at something pretty interesting. It's kind of where the worlds of economics and politics collide. The Federal Reserve, they're about to cut interest rates again,
Yeah.
but this time it's not because the economy is struggling.
Yeah, you hit the nail on the head. The U.S. economy is actually doing really well right now.
It is.
But we've got some other factors in play that are kind of forcing the Fed's hand. Things like cooling inflation and, oh yeah, that little thing called the presidential election.
Right.
So it's not your typical, we need to stimulate the economy situation. It's more like, we need to adapt to this lower inflation environment, which is really interesting when you think about it.
Yeah, it's definitely not the usual scenario.
Okay.
So already intrigued. Can you tell us more about this inflation cool down? I mean, I remember last year's price hikes vividly. It was like everything suddenly cost a fortune.
Oh, absolutely.
Look.
It was a wild ride for sure. We saw inflation peak at a whopping 9.1% back in June of 2022. Can you believe that?
It's hard to forget.
But now, fast forward to September 2024, it's dropped to just 2.4%.
Wow, that's a huge difference. And it's making the Fed rethink those higher borrowing rates they put in place to combat inflation.
Okay, so it sounds like they're trying to find that sweet spot, where interest rates are low enough to encourage borrowing and spending, but not so low that inflation comes roaring back to life. Like Goldilocks, not too hot, not too cold.
That's a great analogy. You're exactly right. But you mentioned the election, and that throws a whole other wrench into the works.
Yeah, the election. It's like the elephant in the room. How exactly could it impact the Fed's decisions, especially when it comes to these interest rates?
Well, let's think about a potential Donald Trump victory for a second and the policies he's proposed. Some economists believe that his stance on tariffs could actually fuel inflation.
His stance on tariffs.
Yeah, particularly his idea of putting high tariffs on all imports.
All imports. Wow.
And remember, tariffs are basically taxes on imported goods, which means higher prices for consumers.
So all those deals he talks about might not be such great deals after all. That's the question, isn't it? We could be in for another round of price increases. And that would probably make the Fed slam the brakes on these rate cuts.
Potentially even increase them again, right?
Exactly. And that would definitely create a lot of uncertainty for businesses and consumers. It's like trying to navigate a ship through really dense fog. You can kind of see where you want to go, but visibility is limited and you have to constantly adjust course to avoid those unexpected obstacles.
So we've got this really complex situation. The Fed is trying to fine-tune interest rates to keep the economy stable, but at the same time, they have to factor in the potential ripple effects of the election outcome. It's like trying to solve a Rubik's Cube that keeps changing colors.
A constantly shifting Rubik's Cube.
And then to add even more complexity, there's this thing called the neutral interest rate.
Oh, yeah, that's a fun one.
I've heard the term before, but I'm not sure I fully understand it. Can you break it down for us?
Imagine a seesaw that's perfectly balanced. That's the neutral interest rate. It's the point where it neither stimulates nor restricts economic growth.
Okay, that makes sense.
But here's the catch. The Fed doesn't have some sort of precise formula for finding this equilibrium.
So they don't just have like a magic number they're looking for?
Nope. They're constantly analyzing data, making educated guesses, but there's always a degree of uncertainty involved.
So it's less about finding one specific number and more about striking the right balance based on a whole bunch of economic factors, which seems incredibly challenging, especially with the added pressure of potential policy changes after the election.
You got it. It's like walking a tightrope. The stakes are incredibly high. Too much stimulation and inflation could take off, but too much restriction and we risk stifling economic growth and potentially triggering a recession. It's all about finding that delicate balance.
And that balance point could shift significantly depending on the election outcome, right?
Absolutely. And that's what makes the situation so fascinating. We're not just looking at numbers and charts. We're witnessing a dynamic interplay between economic forces and political decisions.
Okay, so we've got these rate cuts, we've got inflation cooling down, and then we have the wild card of the election outcome. What are some of the potential consequences of all this? How will these economic forces actually affect people's everyday lives?
That's the million-dollar question, isn't it? And that's exactly what we're going to be unpacking next.
I'm ready. Let's dive in.
Welcome back. So let's get down to brass tacks. How could these rate cuts and, the whole election aftermath, how could those things impact your personal finances?
Yeah, that's what I'm really curious about. Let's say the Fed goes ahead with these rate cuts.
Yeah.
What does that actually mean for like the average person? Someone who's thinking about buying a house or a car.
Okay, so in theory, lower interest rates should mean lower borrowing costs, pretty much across the board.
Okay.
So think mortgages, car loans, Even credit card interest rates, it's all connected.
Interesting. So if I were thinking about making a big purchase like a house or a car, right now might be a good time to try to lock in a lower interest rate.
It's definitely something to think about. Of course, interest rates are just one piece of the puzzle when you're making those big financial decisions.
Right.
But if you are in the market for a loan, these rate cuts could potentially save you a good chunk of change over the life of the loan.
Yeah.
I mean,
Yeah, that makes sense.
mhm.
It's all about timing, right? Trying to take advantage of opportunities when they pop up. But it's not just about big purchases. What about savings accounts and investments? How do these rate cuts play into that side of things?
Yeah, that's where things get a little trickier. So while lower interest rates usually mean lower returns on savings accounts, the impact on investments is a little more complicated.
How so?
Well, it really depends on a bunch of different factors. It's always a good idea to talk to a financial advisor, see how these changes might specifically affect your portfolio and your long-term goals.
Good point. Yeah. It's always helpful to get that personalized advice, especially when you're trying to figure out how to navigate these choppy financial waters. Speaking of choppy waters, let's circle back to the election for a sec. We talked about how a Trump win could lead to higher inflation because of his tariffs on imports, but he's also talked about making big changes to immigration policies, including mass deportations. I'm curious how that could factor into the economic equation.
Oh, that's a really important point, and one that I think often gets overlooked in these discussions about economic policy. Large-scale deportations could really disrupt industries that rely heavily on immigrant labor, like agriculture, construction, those kinds of things.
Right.
And that could lead to labor shortages, which in turn could drive up wages in those sectors.
Okay, so let me see if I'm following this. We could see a situation where certain businesses are struggling to find workers, so they're forced to offer higher wages to attract employees. And then to cover those higher labor costs, they have to raise prices. Wouldn't that just contribute to inflation as well?
Bingo. It's a chain reaction. And it shows how interconnected all these different economic factors really are. Rising wages might sound great for workers in those specific industries,
Yep.
but they can also contribute to a broader increase in prices, which could potentially offset any gains that consumers might see from lower interest rates.
Wow, so it's like a delicate balancing act.
It is. There are just so many variables at play. It's enough to make your head spin.
Yeah, no kidding. So is there any way to actually predict how this is all going to shake out?
Honestly, economics isn't like a crystal ball. It's a really dynamic system with a lot of moving parts, and trying to predict the future with any kind of certainty is pretty much impossible. But that's what makes it so fascinating to study.
I can definitely see the appeal. It's like trying to solve this giant puzzle where the pieces are constantly shifting. So how is the Fed actually approaching this challenge? I've heard them talking about this idea of a soft landing. What does that even mean in this context?
Imagine a pilot trying to land a plane smoothly on the runway. That's kind of what the Fed is aiming for. They want to slow down the economy just enough to bring inflation under control, but without causing a sudden stop that could send us into a recession. It's their ideal scenario.
It sounds pretty difficult pulling off a soft landing. I mean, especially with all the uncertainty surrounding the election and how it could impact the economy.
It's definitely a delicate maneuver. It's like trying to balance a spinning plate on a stick. One wrong move, and the whole thing comes crashing down.
So what are the chances that the Fed can actually achieve this soft landing, given all the obstacles they're facing?
Well, the good news is that inflation has been behaving itself lately.
Okay.
And the economy, while it is slowing down a bit, it's still showing signs of strength. So there's some reason to be cautiously optimistic.
Well, that's encouraging. But I'm guessing the election outcome could still throw a wrench into their plans.
Oh, for sure. If Trump wins and implements those big policy changes we talked about, like the tariffs on all imports and those large-scale deportations, it could make it a lot harder for the Fed to pull off that soft landing.
So we're back to that uncertainty factor again. Are there any key indicators that our listeners should be paying attention to in the coming months to get a better sense of how things are unfolding?
For sure. Inflation numbers, those are always at the top of the list. If we start seeing those numbers creeping back up, especially if it's because of those broad tariffs that a Trump administration might put in place, that could be a sign that the Fed needs to change its strategy.
Got it. So inflation numbers are key. What else?
The job market is another big one. Right now, it's pretty strong. But if we see a big jump in unemployment, especially across different sectors, that could be a sign that the economy is weakening. And it might make the Fed think about lowering interest rates even more to try and boost growth.
So it's this constant back and forth, right? Weighing the risks of inflation against the need to support a healthy job market and, overall economic growth. Seems like a pretty tough job.
It is. It takes a lot of expertise and careful consideration. And there's always a chance of things not going as planned, unintended consequences. That's why the Fed's decisions are so closely watched and debated. They have a huge impact on the entire economy, and their actions affect all of us.
Makes sense.
Hmm.
So for our listeners who are trying to make sense of all this and maybe even make some financial decisions based on what's happening, what's the main takeaway? What should they be paying attention to in the next few months?
I think the most important thing is to stay informed. Keep up with the economic news, follow the Fed's announcements, and try to understand how these decisions might affect your own personal finances.
And don't be afraid to reach out to an expert. Talking to a financial advisor can help you apply these economic trends to your own situation and make smarter decisions about your savings, your investments, your overall financial strategy.
Exactly. And it's also really important to be adaptable. The economic landscape is always changing, so being able to adjust to new information and those unexpected curveballs that life throws at you, that's essential for navigating these uncertain times.
It sounds like a mix of knowledge, vigilance, and a willingness to adapt. That's the key.
I think you nailed it.
Welcome back to the Deep Dive. We've been talking about this intricate dance between rate cuts, inflation, and how the election might shake things up. It's like watching a high-stakes poker game, with the Fed trying to outmaneuver the uncertainty of the future.
It really is. There's so much riding on these decisions, and every move has these huge potential consequences.
You mentioned earlier the idea of a neutral interest rate, that point where the Fed is aiming to neither speed up nor slow down economic growth. But how do they actually figure out where that sweet spot is? It seems so theoretical, like almost impossible to pinpoint in reality.
It's a great question, and it's definitely not as simple as just looking it up in a textbook. There's no magic formula for finding the neutral rate. The Fed has to rely on a whole bunch of economic indicators models and a good dose of judgment.
So no easy answers then.
Not really. It's a constant process of looking at the data, searching for patterns, and trying to gauge how the economy is reacting to the current interest rate levels.
So it's kind of like a ship captain navigating through shifting currents and winds, constantly adjusting course based on what they see.
Exactly. They're looking at inflation trends, employment numbers, consumer spending, business investment. All these data points help them figure out if the current interest rate is too high, too low, or just right.
But with the election outcome still up in the air and the possibility of big policy changes, those waters seem especially choppy right now.
No doubt about it. And that's what makes the Fed's job so tough right now. They're trying to steer us towards the soft landing, but they're doing it with a pretty limited view of what's ahead. And there's always the chance of a sudden storm popping up and throwing them off course.
Okay, so as they try to navigate these uncertain waters, what are some of the key signals they'll be watching for?
Well, inflation data is definitely top of mind. If those numbers start creeping back up, especially if it's because of those tariffs that a Trump administration might put in place, well, that could be a sign that they need to hit the brakes on those rate cuts, maybe even reverse course.
And we talked before about how the job market is such a crucial indicator of economic health. What kind of changes that would be like a red flag that things are heading in the wrong direction?
Right now, the job market is pretty healthy. Unemployment's low. But if we start seeing big job losses, particularly across lots of different industries, that could be a sign that the economy is sputtering. And it might make the Fed think about dropping interest rates even further to try and get things moving again.
So it's this constant balancing act, weighing the risks of inflation against the need to support a healthy job market and overall economic growth. It sounds incredibly complex.
It is. And there's always the possibility of unintended consequences. Sometimes even the best laid plans go awry. That's why the Fed's decisions are scrutinized so closely. Every move they make has the potential to ripple through the entire economy and affect us all.
Makes sense. So for our listeners out there who are trying to understand all this and maybe make some financial decisions based on what's happening, what's the most important thing they should keep in mind? What should they be watching for in the coming months?
I think the key is to stay informed. Pay attention to the economic news. Keep an eye on what the Fed is saying. And try to understand how their decisions might impact your own financial situation.
And don't be afraid to ask for help. Talking to a financial advisor can help you put all this economic stuff into perspective and make the best choices for your own circumstances. When it comes to saving, investing, planning for the future, that kind of thing.
Exactly. And it's also super important to be flexible. The economy is always changing. So being able to roll with the punches, adapt to new information, and those unexpected curveballs that life throws at you, that's how you stay ahead of the game.
It sounds like a combination of knowledge, staying alert, and being ready to adapt is the winning formula.
Absolutely.
Well, on that note, we've reached the end of our deep dive for today. We've explored the complexities of rate cuts, the cooling down of inflation, the uncertainty surrounding the election, and the ever-elusive concept of the neutral interest rate. It's been quite a journey.
It has. And I want to thank our listeners for joining us and taking the time to delve into these important issues. Remember, knowledge is power. The more you understand about these economic forces, the better equipped you are to navigate the financial landscape and make smart choices for yourselves and your families.
Couldn't have said it better myself. And remember, this is just the beginning. The economic landscape is constantly changing, and we'll be here to guide you through it all with more deep dives in the future. Until then, stay curious, stay informed, and stay engaged.